Flaming. Jack always knew it. Jack called it for years. A group has been protesting outside the Bean, also known as the Cloud Atlas, here in or Cloud Gate. Sorry, not Atlas. I'm from here. They've been protesting since the beginning of Lollapalooza. They stand with signs, and what they claim is that when the architect of the Bean originally made it, he stole a baby and put the baby in the Bean, where this man has been living ever since with air vents and food vents. And they claim that when the sun hits it just right, you can see the faint outline of the man trapped inside.
Bruh.
Whoa.
So, I think Top Step TV needs to be there for this crazy, groundbreaking, investigative journalism.
What the fuck are people on, bro? Alright, I came on here to basically just quickly discuss. I'm not even going to be on here for long, but I just wanted to make a quick video explaining some of the current data that's been coming across to most people. Most people are looking at this market right now. Let's just go ahead and look at a 30-minute chart and kind of zoom out so we can kind of see everything since April low. People are looking at this market as it's just on some new bull market rally, that we're just going to continue this bull market forever. And I understand that thesis. It's not good to bet against the bull, obviously, because it's like you're more likely going to lose if you're being a bear, right? The amount of time that the market spends going up compared to the amount of time that it spends going down largely favors the bulls. So I think it's really important for us to keep that in mind of everything I'm going to have to say following that. But when we find rallies like this, where we're having very minimal pullbacks, and I have my tool here to just show, okay? I'm actually just going to even use price range. So on this first rally up, we're going to disconnect this too because we don't need exact. But we only got like an 8-9% pullback. That's normal, okay? That's a normal consolidation. So this first one was normal. And that's what you should kind of expect coming out of this bear market, right? When we have this massive rally, it's like kind of a clear sign to most investors, like, okay, that was the bottom, right? Because we had this big, massive squeeze of short positions. And that's going to kind of propagate and build this support. The fact that all these shorts left the market is kind of like signaling to the bull, like, okay, this is our opportunity to buy, right? And really put it to the bears. Because maybe if you sold up here, you didn't stop out off of that big rally, right? And so essentially, you know from down here that there's still a lot of stops that can be ran. And so there's a good opportunity to buy because we've already seen that the bears were quick to get out of the way. And that was obvious because the tariff pause also came in too. So if you want to look at it from more of like a fundamental nature, we had this external pressure that was coming into the market that was causing this massive decline. And all of a sudden that external pressure was mitigated and became null. And so we ended up getting this massive rally back up, and it's exactly what you would expect, right? If this was all created from tariffs from April 2nd here, right? And April 2nd, this high, then if the tariffs were to get paused or got rid of, then because that's essentially what being paused means, right? When the market is pricing in things, it's pricing it in for the present moment. It's never looking 3 months down the line. It's looking at the present moment because even if the pause was only 7 days, right? It's like, okay, well, those 7 days allow you room to get out of those positions within those 7 days, right? So it's like if they had paused for only 7 days, for example, for a week, okay, then there would have been a rally up. It probably wouldn't have been as strong because there would have been opportunity to sell out of those shares that you had bought from the bottom, okay? And then you could have just wrote it back down after post the tariffs, right? And the reason why the market's pricing in such a big discount during the tariffs is because that's a massive amount of money that is being taken from the corporations. Okay, this is obviously all about earnings. So we're talking about company revenue and growth. And so if their growth is being basically circumvented by these tariffs and they can't grow at a nice steady rate, then that's going to be reflected inside of the stock price. Same thing as their earnings, right? If their earnings are going to go down because tariffs are going to go up, meaning that the consumer might be less likely to buy a product. Maybe as, before he would buy 3 of something for his company, his little small business. A contractor might go to like Lowe's or something for like that for like some plywood. And he might buy like, a bundle of plywood. And now that the prices have gone up, he simply can't afford that because the small business owner didn't just randomly get a whole bunch of extra orders that he has to fulfill, right? So now he has to skimp a little bit and make sure he gets precision cuts on everything, doesn't have to, doesn't have the luxury of making sloppy cuts, and so everything has to be kind of more efficient. And so he, instead of buying a bundle, he only buys, let's say, three sheets of plywood, right? So that's the point of why it started going down on tariffs. So when you pause that, even if it's for a week, you're going to get some sorts of bounce because it's only pricing in for the present moment. Okay? But when they paused at 90 days, that gives them a whole month and a half to get out of a position. That means that there's going to be, in a month and a half, you have how many days? You have, you know, 5, 10, 15, 20. So you'll have 30 days, trading days, to get out of a position, basically. Okay, for profit. It doesn't matter how much you made as long as you make money, right? And so it's clear that when you get that pause, you're going to get this rally. And so this all makes sense coming into here. And then this pullback also makes sense. Because like I said, if you know that the tariffs are going to become unpaused in 90 days, you're going to be looking along the ways after you've bought here to be taking profit. And they probably didn't take their full profit here, right? Because they know that they have 90 days, but they took some off right away because that's a good massive rally that they made in one day. Is 12% in one day. You might as well take some off and mitigate your possible downside. That's like essentially making it a lower beta play by essentially taking some of the risk off of the table. And so that's what they did. They had a little bit of a pullback here, and then they wanted to retest those highs. At a certain point, this is probably somewhere around 50% if I had to guess. Yep, just about 50%, 68%, 61%, whatever. That's when they decide, okay, well, this is kind of now going back down as if tariffs are still a thing. And so new buyers come into the markets, the ones that were late to the party. They didn't buy that initial rally up, and they felt like they couldn't buy it on the way up because it's already so overextended. When do you buy it on this rally? Do you buy it when it's up 3% on the day, when it's up 4%? What about 6%? Are you likely to buy it? Because you know that tomorrow it could just go against you, right? And so you sit there and you're like, okay, I'm not going to buy it today. I'm just going to let it go without me, and I'll buy on the pullback. And so that's essentially what they did. They waited, and these are new buyers. So in a way, you can also imagine that that's what the market is doing. Some people that are traders, for example, will say that they were looking for more liquidity. They were looking for more buyers essentially to come in, and that's what they did. They ended up selling until they found new buyers. And when the new buyers came in, those old buyers that were selling into them probably switched their consensus and said, okay, well, there is some buyers here. And so now that there is buyers here, I don't need to sell anymore because I know that the price can continue going up and I can sell at a better price. I might as well buy also with them. Okay, and so that's what you end up getting. You get a little bit of buying going on here, and we get back up to that high again where the initial sellers, the big boys that were in first, they're like, okay, we're basically back up to that same position, right? I might as well take this off because again, they're just going to slowly take profits and take profits and take profits. Okay, and so you get the same exact effect. We end up coming down, scaling lower and lower and lower. And now that we have these new buyers that came in here, right? One of the ways that they're going to essentially do this is that the sellers that are going to come through here, they're going to look for even more buyers, okay? Because they know that the buyers were slowing down up here. Okay, they know that the buyers were not strong enough to overcome their sells. And so that's essentially telling them that they're in a risk position here because if they're continuing the same level of selling, right, which is like their projection that they think with the volatility they're taking in all these Greeks into their account, and they're using equations to basically say how much do we need to sell in order to get out of this position completely before the 90-day pause is up. Okay, and so they're going to keep selling no matter what. Okay, and so they're selling into you the entire time, but they sell in more when it gets up to this high here. So it's like an exponential graph, and they use a logarithmic curve to basically show like how much they need to be basically putting in. When the price is really high like this, the log function looks like this, right? So their selling is increasing when it's like all the way up here, but when it's decreasing like this, and it's going lower, the logarithmic curve of selling turns back out this way, right? And so that's what they're using. They're using logarithmic regression to basically tell how much they should sell of their shares, okay? So that's what they do. And when they come down here, they basically say, okay, we are back from going like this, right? Now we're going into negative from that initial buy here, right? And so at a certain point, this is just their selling equation, okay? But what about their buying equation? Because they also want to essentially get back to this side of the logarithmic curve, right? They don't want it to balance out and they just have like no growth happening, right? Very slow growth happening. They'd rather sell for a lot of money than a little bit of money. And so when the times are rampant, this is like when we're at a high and this is actually a low. So it's a little bit inverted, right? You'd think that it'd be the other way around, but this is the way it is, okay? So when they're buying, they're looking to keep the buyers going exponentially higher, right? They're trying to get the amount, the volume of buyers compared to sellers. They're trying to get that to go exponential. And for them to do this and bring it back down, what's happening to these buyers is that they're actually going onto a logarithmic curve like that as well as we get lower, right? The buyers are going to get slowly dwindled out. And then once we break this low, then that's when the buyers slowly starts to turn exponential and it turns the other way, okay? Because it becomes a discount price, okay? So buyers are not going to be prudent to be buying in here because we are within this range, right? They're not going to be really interested in buying because there's chances we just break the low and we keep going lower, right? So anyways, all this to basically say, I'm going to go ahead and skip ahead. I don't want to give a whole entire recap, but this entire thing was 9% from that top there to this bottom. And that makes sense, 8.5%, 9%, whatever, okay? That makes sense. That's a usual pullback in the market. You usually get about 5, 6%, and when you get an overextension like this where we went up 12% in one day, it's likely to mean revert a little bit higher than that 5-6% average and go to like 8-9% average. That's just normal, okay? It's like mean reversion, bringing it back to like a central point. But once you hit that low and you rally and you break out of these highs here, that's when a lot of people were calling for longs, right? And that's when the institutions are thinking about now maybe some of the risk has been mitigated, because if we can break over these initial buyers, that's essentially saying that these pauses, the tariffs, are actually really bullish. It means that whatever was happening to the tariffs, this was the full effect of it. That even with the tariff 90-day pause is going to give the market time within those 90 days to make new gains and new revenue, that even after the 90 days pause comes back in, right? If we measure what that move did to the market, it dropped it 15%. If you have 90 days, in that 90 days, let's just say for, sake of argument, you go up, let's say you go up 25% in those 90 days, meaning that your revenue goes up 25%, okay? Then when the tariffs come back into place, assuming that no tariff deals end up getting cut and any of that, then the maximum that you're really expecting from that is a 15% low, right? You're looking for 15% lower. And so you're still going to be above that. And so at this point, when they break over that high, they're essentially saying that, okay, the revenue growth is back on the table. We're actually going to continue growing at a steady rate, and that the tariffs are kind of already caked into the equation. So what ends up happening, though, how do they get that revenue growth? Because tariffs are on the table, right? If tariffs are going up, then the consumer should be going down, right? The consumer should be buying less. Well, the truth of the matter is simple, is that the consumer has not really gone up. The consumer has been more wary, if anything, because inflation's still been steadily, it hasn't been going up as much as it's been going down. It's been kind of going down, but it's very steadily going down like this, and it's still somewhere around 2.5 to 3%. Okay? So it's still elevated, but it's like still 2.5 to 3%. So your prices are going up over time, and that's causing this kind of grip on the economy where the consumers are slowly dwindling down as well because they can't afford to buy as much that 2.5%, 3% is caked into almost everything that they're buying, right? So their insurance bills are going up, their electric bills are going up, everything's going up. So these consumers can't afford to buy these, especially the discretionary items. So you saw in a lot of the economic data that we've been having through these months that the consumer discretionary has been going down. Okay, that they haven't been seeing much growth from that. They've been actually seeing massive declines and unwindings in discretion. Okay. Meanwhile, consumer confidence remains high, which means that the consumer confidence is showing that they think that people are going to continue to buy. It's not like we're going into some shutdown of the economy. Okay, and that's because small businesses still have to run. And if they don't run, what are they going to do? Inflation's still going to remain that 3% or whatever, right? And how are they going to be able to afford that extra 3% if they don't work? They still have to work. And if anything, they'd be looking to work harder so that they can afford to pay that 3%. And so consumer confidence is still high, okay? Because they know that this growth is coming into the market, that they have to basically, because they have to, it's the only way that they can stay afloat. And that's all to say, people are imagining that consumer confidence implies that these people are making more money or that these people have more money, but it's actually the exact opposite. The consumer confidence is showing right now in this market where we have this steady inflation rate of 2.5 to 3%, is really showing that these consumers can't afford their cost of living, and so they have to work harder. And so that's why they're keeping this, consumer confidence going up. And so, anyways, going back to the point, when we break from this highs, okay, we kind of start getting more bullish. The companies start creating more growth. But how do these companies create that growth and increase their earnings and their earnings expectations? Well, that's because prices are going up, right? If you just look around in your daily day-to-day life, you can see that, fast food's going up, your insurance bills, like I was explaining earlier, right, with small business analogy, but that's for everybody. And so if prices keep going up, that's only possible due to inflation. If the tariffs are paused, right? We know that the tariffs are paused, so we know it's not the tariffs that's causing prices to go up, right? But the inflation rate's only like 3%. But a lot of people have been realizing that their insurance rates and all these things that they buy are going up much higher than 3%, much faster, because 3% is the annual rate, right? So if you take 3% divided by 12, right, that's how much percentage should be going up per month. Okay, and you should really do that divided by 4, right? So you get 0.75 basis points or you get 75 basis points of increase per quarter, okay? So it's been going up much higher than that. So we can basically round up to 1%. Okay, we'll make it nice and easy. We'll even put it higher than what the inflation rate is. Okay, we'll simply say that it's 1%. Okay, so if it's 1% per quarter that it's going up, then an item that is $10 should be going now for $11, right? But when you go out in your daily life, if you're observant and you're realizing all these things, you're realizing what the current inflation rate is, what the real inflation rate is, which you can go to certain websites for, you're realizing that this change is not realistic. That it hasn't been going up just $1. That actually what's been happening is that they've been pricing in multiple 50 to 60 cents to 70 cents, depending on the item. They've been pricing in higher increases, and they've done that maybe 2 or 3 times in one quarter, okay? And so they're pricing in and they're making everything higher than what the inflation rate is. So how can they afford to do that? Well, it's because this tariffs is the perfect red herring, okay? They have this red herring going on that the prices are increasing due to the tariffs. Okay, and so to the blind consumer that doesn't really pay attention to the economy, doesn't pay attention to economics, doesn't know anything about it, doesn't watch CNBC or anything like that, he just has a business and he realizes that prices keep going up on everything and he knows that it's due to inflation, right? He knows that that inflation rate has basically been remaining steady at least because he knows that, his prices are going up a certain amount per annum, right? But now all of a sudden, if he were to, have like a spreadsheet and has an accountant or something, he's realizing that he's not bringing in as much revenue growth for the same amount of work, and that's because the prices keep going higher. And so when you get a nice accountant or you have like an Excel sheet that's showing you all of your expenses, you're seeing that your expense column is going higher than usual at the usual rate of that inflations. And so you ask yourself why that is. And it's because of these tariffs, okay? And it's not to say that the tariffs are the reason doing it, because the tariffs at this point, when we're in May, after April, it's still within that 90-day cut period and prices are going higher, okay? And then they're going at that increased rate that I was explaining. And so what's really happening is they're using the red herring as an excuse broadly throughout the entire industries. So like let's look at like the food industry, for example, food and bev, okay? The food and bev industry can only charge higher. And the thing about being a corporation you have to understand is that they're always going to charge you the maximum they possibly can without decreasing the demand for their product. Because if Coke all of a sudden decided they were going to charge $100 for a Coke, nobody's going to buy Coke, they're going to buy Sprite. Okay, and Sprite's only, what, $3 a can? So they obviously can't charge the outrageous price of $100. They have to find some middle ground, okay? And that's basically done through supply and demand. And that's done through competition within the marketplace, within the industry, okay? So if, Coke ends up charging more for their product and Pepsi then undercuts them and says that we'll charge you 30 cents less per case or whatever, and maybe you sell a whole bunch of Coke, right? Because you're like a food and bev industry, then that 30 cents is going to be more optimal and you're going to be buying Pepsi's product, and that's going to even further take from Coke's profits. They're not going to make as much, and so what's liable to happen is that Coke will decrease their prices by 30 cents, okay? And they'll find this balance point where the industry as a whole finds how much they can charge for a product. And it can't go higher without decreasing the demand, right? If the demand goes up, then that means the prices came down, right? If the prices go down, that means the demand is going up. Okay? I'm sorry I said that last part wrong, but anyways, the point being is simple, is that they're using the tariffs as a red herring because the industries as a whole are colluding together, and it's not even that they're doing it on purpose. I'm not saying there's like some sorts of cabal that's running everything, telling people to raise their entire prices. I'm saying that they're all realizing the same exact thing, and that's that these tariffs down the line will affect their revenue growth. And so why not preemptively basically try to combat that to make sure that they don't lose as much money as they're expecting from these tariffs? And they can do so by building a buffer. Okay, you build this buffer, this surplus of cash, of revenue, which is more than what you expected to make. Okay, and if you know anything about the economy, when you have earnings reports and earnings season, that's what's happening right now, right? All of these tech companies especially have been beating on earnings. But even companies like Eli Lilly, for example, okay, Eli Lilly beat on earnings by a large margin, but the price ended up going down for other reasons, okay? But Eli Lilly's beat on expectations. And that's what I'm saying, is that they have built the buffer through the tariffs. And the only reason why this buffer was able to be created is because the consumer knows that tariffs are inflationary. They've heard through all the news outlets, etc., that the prices of everything's going up because of tariffs, right? So when the consumer hears that, they don't question it. They don't question why, things are going up. They just automatically assume, oh, it's the tariffs. But meanwhile, the tariffs have been paused. So the company that's importing from the tariffs, their cost remains the same. This is prior to tariffs and this is after the tariffs. It's because they were paused, they're still the same, but over here they're charging $5 for the item and over here they're charging $6. Okay? And the reason why they're able to get away with that is because the consumer is being blind. They're saying, oh, the prices went up to $6 because of the tariffs. Okay? And that's allowing these companies to build this buffer. And that buffer, what that really means is increase in earnings expectations. per the quarter. So if you look at their earnings reports, they're basically giving you projections about how much they expect to make, how much revenue growth they expect to make for the quarter. And they've all been already kind of mitigated because of tariff news, okay? When they knew that tariffs were coming out, they all lowered their expectations for the year, and they didn't ever revise their expectations to after the pause to be higher. They just kept them the same as low down here, so that when the earnings report comes out and the tariffs have been paused, and so they haven't had any effects of tariffs, essentially nullifying the tariffs, they already decreased their expectations, and now on books, if just to the blind eye, it looks like we're beating on expectations. Like there's been a huge increase in what we expected. Like there's some huge new growth in the economy, but that's not true. Okay, and so what's happening right now is that's what's getting cooked into the market. Okay, we're getting a bunch of pension funds, etc., that they buy based off of fundamental growth, and hedge funds, even for example, they buy based off of all this information that they have available to them, and the information that they have right now is telling them that the earnings reports keep beating expectations and that growth is happening, and that's the standard because the tariffs have been paused this entire time. But as of August 1st, what did we get? The tariffs officially were unpaused after being paused and then delayed again and paused again for another 90 days, another 90 days. It just kept getting paused. Finally, August 1st, Trump stopped chickening out. Okay? And this all made perfect sense because why did he pause it? Okay? He paused it 90 days from April, and so that would take you out until like middle of June. Okay? What happened in middle of June? You got a slight pullback because people were anticipating that the tariffs were going to go back into effect. Okay? That's what happened here. And then what happened? Trump chickens out again. And why did Trump chicken out? Because there was a chance that if we continue to pause it, let's say we pause it another 90 days, and now we're talking middle of August / end of end of August, which is where we are. Okay, we pause it a second time for 90 days here. Then we get that same continued growth because nothing's changed. The companies are still using that same thesis. Okay, they're still using that. We keep the expectations, the revised earnings after the tariff announcement. We keep those revised expectations the same. We don't change them to make them back to normal without the tariff influence. They're still pricing in the tariff influence even though tariffs have not been around. And so on books, on paper, it all looks good for these companies because they're beating on the earnings expectations. And so Trump knows that if he delays another 90 days, that allows even more companies to report this falsified earning information, which will continue to propagate the market up. Okay, and so that's what's happening. Essentially, we got the pullback in June that we expected from the tariff shock, right? But he delayed it again. He delayed it another 90 days. What happened on that 90 days? He finally stopped delaying them and just enacted them because at this point where the market is at all-time highs again. Okay? At this point, the earnings expectations, everybody is super over bullish on the market at this point because we're breaking out to new all-time highs again, and it's like, well, the market only goes up, right? And they're like, everybody's like sitting there doing a victory lap. They're all doing a victory lap because we got out of this 20% decline and now we're rallying. We're just going, right? And they can't expect, they don't like see and fathom a way where we end up coming back down again, right? Because they're saying all the tariff news was caked in. They're saying that the tariffs didn't affect revenue. They're saying the earnings reports are good. The consumer confidence is high. All these things, right? And they're looking at this data, but they're looking at it from a false lens. They're looking at it from the naivety, okay? The truth of the matter is that the consumer confidence is not high and that it's actually remained steady, okay? Because inflation has remained steady. And now that inflation is looking like it'll go back up, okay, they've been seeing data from unemployment and etc. They've been seeing things that inflation might actually have to keep going up in the near term. Now they're talking about, okay, well, the unemployment data has been getting bad, so we need to cut interest rates. That's what they keep talking about in the Federal Reserve, how Trump wants Powell to cut the interest rates, he's saying that because the unemployment data has been sketchy. It's been going down because of AI and a whole bunch of other things, okay? And it's not just AI growth that's been making people lose their jobs. It's been a lot of stuff. It's been companies as a whole, right, realizing that they need to do some downsizing, okay? Because during the Biden campaign, the Biden administration, there was record levels of job growth, and a lot of these jobs that were added are kind of your low productivity remedial workers, entry level. A lot of them were government positions. And you saw this massive decrease in when Doge came around in the beginning of the year. They started cutting a whole bunch of jobs in some of these federal organizations because they weren't doing anything. They were overstaffed essentially, and so they started cutting them, and that eventually works its way into the public sector as well. So it's like the public and the private sector, it's going to eventually work its way into both. And so they basically start cutting jobs, and they're seeing that the job growth has been kind of sketchy and been decreasing. And so that's leading Trump to think that they need to decrease the interest rates to essentially give companies more ability to pay off debts. They don't have to pay as much towards their interest on any debt that they might have, and it also allows them to take out debt, and that debt can then be spent on payroll, and that can help the jobs. That's what the Federal Reserve does. Okay, they manage the interest rates and quantitative easing. Okay, so the interest rates is essentially, if they keep it up, it's because they have too many jobs. Well, it's not because they have too many jobs, but it's because the inflation is going too high. Okay, it's too fast. It's increasing too fast. And so they have to increase interest rates so that people stop borrowing money. And when people start borrowing money, it quantitatively tightens the market, right? And so that brings inflation back down. And so that's why they keep them elevated, the interest rates, so that people don't continue to borrow money and spend, spend, spend. Because as soon as they start spend, then the market inflates. And that's all because they have basically added money into the system via money printing. But if the common consumer gets a hold of that money, then the inflation rate will go up. And if the banks, what do banks do? Banks take that money and then lend it out on debt, and they make money based off the interest. And so the banks are really holding on to that cash, which is what the Federal Reserve is. It's a federal bank. They're holding on to this massive amount of cash, and they're putting it into long-term treasury bonds or short-term treasury bonds, either or. They're putting it back into the US government, taking it back out of the system. Because when you buy a bond, you're locking your money up for 10 years, for example. Okay? And so it's essentially them taking the money back out of the market by doing so. But if the consumer, if the interest rates remain low, they can run to the banks, like the Charles Schwabs and all the, that's not Charles Schwab, but the Chase, Chevy Chase, the Bank of America, and they can go look for a loan, and they can get or like a mortgage, and they can get a 0% interest rate, and because the interest rates are low, and they can just borrow on massive amounts of money, and that's going to allow the consumer to have more money than they can afford in a certain year, and that's going to keep the inflation increasing. So that's why they have to increase the interest rates. Okay, and why Powell has been speculative not to decrease them is because he's expecting the tariffs to be inflationary. He's thinking that the tariffs are going to be bad, and he hasn't seen any data for them yet. So what Powell's doing is actually right, because the tariffs are inflationary. In the short term, they are inflationary. And the reason why Trump, on the other hand, is saying that we need to lower them is because unemployment has been very uncertain, and the reports have been kind of bad. They haven't been giving very clear data on how bad the unemployment crisis is. But therefore, Trump is foreseeing this massive AI boom, right? He's talking to all these AI corporations, and he's seeing that the AI is eventually down the line going to lead to unemployment boom, right? And it's just a matter of time. More and more time goes by, you're going to get behind the curve, and he's saying that you should drop these interest rates ahead so you can get back ahead of the problem rather than waiting for the information. And the Federal Reserve has always been information based because they aren't political. They aren't sitting there saying, oh, this is what's going to happen and this is what we foresee. They're saying, okay, this is the data. This is what we have to do in response to the data. And so there's a saying all the time that the Federal Reserve is always behind. They're always too late. Let's go see what it's doing. Still nothing. So on one hand, you have Trump that's saying interest rates should decrease, and that'll create more economic boom, and then it'll also cause more inflation. Okay, inflation will keep going up, but that's because Trump has been basically incorrect about this whole entire equation. He's operating underneath the assumption that these companies, the increase in the revenue that they've been earning, that little buffer that I was talking about, that buffer was in response to the fact that inflation was going to go up, and so that buffer is going to be void. It's going to be nullified, and so Trump is basically betting that the market is going to correct itself back down to a norm. And I'm pretty sure that Trump wants the market to finish somewhat flat on the year. Probably if he could get it back into this consolidation zone by the end of the year, that's where he probably wants it. Okay? And he'd do that by essentially creating, excuse me, he'll do that by essentially creating a bunch of, risk headlines. And that's what he does. He goes on Truth Social all the time and he tweets about, I need to firepower. And then what happens? The market dumps. Okay? And it's just about how serious the market takes Trump's words. Okay? Because they really shouldn't be taking him as some sort of economic genius. He's not. He's actually very poor at the economics of the country. He was expanding his real estate during the 2008 bubble. He wasn't selling it. If you're a good economist, you realize, for example, like Michael Burry, right? He realized that they were selling subprime loans, that this was going to cause an issue down the line, and that issue would essentially cause the market to crash. And so at that point, he starts selling. He starts short selling, because he's looking at like portfolio management and stuff. But if you're an actual real estate manager, that's when you start downsizing. Instead of expanding and buying and buying and buying more casinos, you start downsizing. You start selling things off, and then when the market crashes and they have to decrease the interest rates lower, because when the interest rates go down, that's when spending goes up, and that's how you recover, right? They dump a bunch of money into the system, okay? The Fed starts printing money, okay? Fed prints money, it goes to the banks, okay? The banks basically take that money and lend it out to you as well as the government, okay? Because they use treasury bonds, but they give it to you, and then you pump the market back into going back up because you got a whole bunch of cheap money. Okay, but that's inflationary, and so down the line, and they only do this for so long, where the banks are lending out money at low interest rates before the Fed comes in and starts pumping the interest rates back up, so that everything gets quantitatively tightened, starts flattening out. Okay, and so what they're doing is they're taking it like this, right? They're trying to keep it going up like this, propagate it forever. Eventually down the line, that's leading to like all these headlines you see on YouTube about the everything bubble, because everything's being pumped up like this, right? By the Federal Reserve and this falsified money. But the concern is that the dollar is never increasing. If you go look at the, DXY, and you look at the daily chart, okay, well, let's go look at a weekly chart. The dollar doesn't increase. Okay. You can see that we've been making lower highs and lower lows. Okay. And that's just the way it'll always be. The dollar will continue to be devalued, but this is like one of the better currencies. This is for every currency though, because every currency is what, Euro cash is it? I don't fucking know. I don't do it, but that's not right. I don't know. What is it? Go look at the yen. If DXY is the dollar currency index, EXY? Yeah. There you go. That's how easy it can be to find a ticker sometimes. Yeah, so this is the euro. It's been decreasing in value. That's just how the currencies always go if it's fiat. If it's fiat and it's not backed to anything, it's just going to slowly unwind and become worth nothing eventually, which is what leads people into buying Bitcoin, okay, and why Bitcoin price has been surging because it's based in US dollars. And so if US dollars are becoming worthless, and Bitcoin remains the same supply, there's never going to be a more than 21 million coins, whatever. Money that's in the USA, there's going to be more of it. There's going to be more dollars, okay? Which is going to cause the value of the US dollar to go down, right? But when there's more US dollars, then when an item stays the same in supply, okay, even if demand stays the same and they don't ever find new buyers, then eventually over time it's going to cause Bitcoin to go up in price because there is no other option. It has to go up, right? Because the US dollar has pumped more money into the system and the value of the dollar has gone down, okay? And so Bitcoin is not only solely based on the US dollar either. They have, euros you can buy it with or whatever. You can buy into many different ways into Bitcoin. They accept all sorts of payments, and then those payments go to some exchange, and the exchange is mining the crypto, right? And so it's all based off of electric fees are the idea. Okay, that's one way, and that's a very smart idea that somebody came up with, Satoshi. And then there's the other idea, which is gold, which has been skyrocketing recently, and this is the tried and true. Everybody knows that this is what, works. You have gold, and gold does not get used as some sorts of expungent money inside of your system. You don't circulatory gold, and the reason for that is because it's too heavy. Okay? You can't take $1 million worth of gold very easily around the world. Okay? And so that makes it even easier for the government to control inflation because all they have to do is just control how much gold is being moved within their system. And when they supply it, the problem with gold standard is that if you don't have industry inside of your country, then you get fucked because the industry is what's going to bring gold into your country. And if you don't have the industry inside your country, then you're essentially giving away gold. Eventually, you have no gold. Eventually, you have no money. Okay, and so that's the problem. And so Trump foresees this. Okay, so down the line, what Trump is doing with tariffs is the correct thing, in my opinion. I think it's the right thing to do. In the short term, you cause a bunch of turmoil. It's going to go down because of inflation and all this stuff. But that's going to happen either way. That's just the natural course and natural process. Whether it's a crash that's going to happen, whether it's war, whatever, there's going to be some sorts of turmoil that's going to cause you to have to print money. And that was like put on full display during COVID. There's going to be like a virus that comes out and shuts down the economy. Okay? And so that causes big problems because we know that COVID was a man-made disease that was propagated by China. So China could use biological weapons to bring down the US economy. So that's part of the reason why the gold has been pumping because people like China have been buying it up. Okay, and the BRICS companies as a whole have been buying it up. And it's why Trump is pro Bitcoin right now because America's winning on Bitcoin adoption. Okay, we have been buying up a shit ton of Bitcoin through the ETFs, through the all these different things. So since Bitcoin's been getting pumped so much, that's like the US way out. They're thinking cryptocurrencies, and some people claim that XRP is going to be the one. There's so many different cryptos it could be. You never know which one it's going to be. And I imagine that US will make their own fucking token, and it's still not even been created. So all that is just a fucking lie. But I don't know. But it obviously makes sense for them to use Bitcoin as the backing of it because the Bitcoin has already had all the US dollars inside of it. And the US dollars originally, the amount that they started with was backed by gold, right? So there is still a little bit of gold within Bitcoin. Technically, even though it's just a US dollar and it's fiat, there's still trace amounts of gold that's valued into Bitcoin right now. Anyways, point being is that that's the reason why gold has been going up. And Trump is foreseeing the fact that if we go back to the gold standard, which is highly likely, considering that there's a lot of current support for it as of right now, a lot of these major countries, Russia, Brazil, India, they're all supportive of, these Russia, India, Brazil, and China. Those are some of your biggest populations in the world. And so if the most amount of people are saying that we should use gold, okay, then he's essentially anticipating that we're gonna go back to the gold standard. And if we do, American industry needs to be very strong, because if American industry is strong, then we can basically bring the gold standard back, because people will be supplying gold into our United States. Okay, so there's a lot of these like weird things going on right now where like he seems like the bad guy, but truthfully down the line he'll be a good guy. Okay, and it's just a matter of time. You have to give it time to work out, and everybody's so worried about the process of like right now and right where we're at right now, what's happening. They're too zoomed in, right? But back to the point, we're gonna go look at the entire thing. Okay, so what the fuck? What we were saying was that we started going up due. Wow, look at all this bullshit. We started moving up because of all of this tariff buffer, and now Trump is trying to basically get us to decrease the interest rates, which will cause even more economic booming. And he's doing that because in anticipation, and that's obviously going to move the market up. So remember what I said? I said he wants it to go back to somewhere around here. He would love to be able to do that by the end of the year, but that's just not feasible. He knows that in order for that to happen, there would have to be some sorts of war or something like that. And he's not for war. He's not a fucking terrorist, and so he's not gonna do anything this year. Rather, he would rather have the market move up very strongly and have some sorts of like blow off top is what they would consider it inside of trading. Okay. And when we have that blow off top, then boom, we have another like 20% up here, and that can help him win the midterm elections. And it's a lot of benefit for him for the market to continue going up. And then next year, going into this economic turmoil where the interest rates are low and unemployment's going up, okay, what do you do if unemployment is going up? Is that you decrease the interest rates. But what happens if unemployment is going up while also inflation is going up because of your tariffs? Okay? You've put tariffs in place. You're going to be either encouraged to get rid of those tariffs to get rid of that increased inflation, but we just explained how if they go back to the gold standard, they're shit out of luck, and that's why the tariffs are necessary, because it brings industry back into America. And the adoption of these corporations to bring industry back into America has not been rapid enough. So what happens is a big pickle. You're going to have a big situation where he cannot take off those tariffs, and so inflation is going to remain high. Okay, and you get into stagflation. Okay, where it just continues to get higher and higher, and there's nothing you can do about it, because if you decrease them, then the unemployment's going to go down, which is what you want to happen. You rather people are working than not working, right? And because if people are not working and they don't have money, and inflation's still going up, then that causes depressions, not recessions, depressions, because nobody has a job, nobody has enough money, and nobody can afford anything because prices are out of control. That's like, think about the Nazi Germany right before World War II during the Great Depression. You get a depression if that's the case. Okay. And that's going to obviously end up with markets going down because earnings growth is going to go down because people can't afford anything. Okay. And so what he'd rather happen this year is that the market continues rallying, has a blow off top. And so when the recession happens, most recessions are only like, unless if it's a crash, like a 2001 crash or a 2008 crash, those are like 50 to 70%. But like a recession, like in 2022, was only like 30%. Okay, and so if we break out and we rallied 20% over where we started in the year, and then we recede down 30%, we'll be pretty much flat. And so that's like good for the economy because it gives them more time. It just delays the problem, right? While also bringing industry into America, which means that when they go back to the gold standard down the line, whether it's 10, 15, 20, 30, 40 years from now, America will be fine and they'll still have economic dominance. While also the market continues to go up, and so investors are still very bullish on America as well, and so we can maintain our economic dominance no matter what. So that's the current goal of what's happening here, is that they're keeping this all under guise. You're not going to hear this in the public narrative of what's going on in the media because they don't want you to know that. Like I explained earlier, they're trying to keep you in the dark, the consumer in the dark about the prices going up and blame it on the tariffs, which have just now became a thing, which is why recently we had that massive pullback on the beginning of August 1st. What happens? We gap down off the tariff shock, okay? And then what ends up happening is that he cuts a couple of more deals with a couple different countries and we go back up. And then after that, he makes an extra, I think 15 or 20%, whatever it was, on India for buying Russian oil, and we go back down. And he makes some more deals and it goes back up. And so we keep getting this up and then up and up and up. And then we have Microsoft earnings and all these big tech earnings that come in and really prop the market up. All right. And so anyways, all of this to basically say what we're doing. Well, this was Microsoft earnings actually right before August 1st. But, point being is that we had a whole bunch of earnings come in here and we had CPI data that was saying that, core production index or whatever it is, fucking CPI, whatever the hell it is, was saying that is bullish, but year over year growth is down. So it's like kind of wonky data. But like I said, they want to keep propagating this market higher, and so the public narrative right now is that the market's just going to keep pumping and pumping and pumping because they're trying to get a whole bunch of value out of this, and they'll say, "Oh, it's because the institution is late, so the institution has to keep buying it up," or they'll say, "Oh, the institutions were offsides, and so they have to continue buying it here to manage their positions accordingly because they were offsides." And so that's why the price keeps going up. No, it's because they're trying to keep this up so that when it does come down, which they know is very soon, it doesn't actually affect in the long term. Like if say, 5 years, 5 years it'll be flat, right? So they know that the young people on record amounts, our generation, like the millennials and the Gen Zers, Gen Xers, they're all on record amounts investing inside of the SPY and the triple Qs, the indexes, because that's what they've been told to do. They realize that they aren't good stock pickers and that they'd be better off just tracking the market because it goes up 10% a year, right? And if it goes up 10% a year, then they can be a millionaire when they retire. But what happens if that becomes the standard? The norm is that we go flat for 5 to 10 years. Well, that takes a lot of that earnings growth out. And so what they're telling you is always a lie. Remember that. Every time that whatever they tell you, it's always a lie. Why would you need to be told something? Literally, why would you need to be told what to do? Think about that. They tell you to go to college. I just saw data on this the other day. The only job, the only field in college that does not have any expected value loss from the amount of money that you spend on tuition
to getting a career and being able to pay it off, like the only actual industry to go into, the only thing to get in a degree in that doesn't have an expected, or at least a chance of an expected decrease in return value, is engineering. You go into engineering and you're fine. That's the only, like, if you're saying I want to be an engineer, go to college. I'm telling you, go to college, because you will get that money back. You know, engineers leaving college on average now, I think, are getting paid somewhere around 70,000 a year. Okay? And so, of course, you're going to be able to pay back your college, because what college is $70,000 a year? Even if you go out of state, like Penn State, for example, for me, out of state was like $40K a year. So if you're getting paid $70K a year, eventually you're going to be able to pay it off. So the expected value is there. Plus, you're going to get raises through the career that you choose. If you're like an electrical engineer, after 5 years of being an electrical engineer for a company, you're going to get raises along the ways. So from 70K, you might go up to 110. And so at that point, you'll be able to pay it off even easier. So engineering makes sense, but every other field had at least a percentage, at least a small value. It wasn't like saying, oh, if you go into this field, you won't ever make it. That's not what I'm saying. Like, even if you went into liberal arts, which was, by the way, the worst expected return on value on your investment, even if you go into that, there was still like a 20 to 30% chance that you would be able to retain value from your degree. And that's like, of course, like if you were at a liberal arts degree and you go into like, you know, acting or something like that, and you actually make it in Hollywood, you're going to get paid millions of dollars, you know, or even hundreds of thousands of dollars for appearance. You're going to be able to pay off your fucking government or your student loans. But, you know, what's the chances of that are lower, because what's the chance you're going to make it to Hollywood and be in some movie that makes you millions of dollars? It's low. And so it was like a high percent. I think it was like 55 or 60% for liberal arts. So, I mean, all of these fields have at least some expected value decrease, but engineering is the only one that had a 0%. 0% of people that go to engineering, which this can't be 100% correct. They're probably rounding these numbers, okay? But there's probably at least like, you know, 0.5% of people that get an engineering degree and then don't end up doing that, right? Getting that money back. But I mean, now this is also expecting that you go into a field that is relevant to your degree path. It's not saying going to get an engineering degree and then not doing engineering as a job, an occupation, right? This is saying if you went to school for engineering and you become an engineer, what is the expected value of return? The same thing as if you go into liberal arts and you go into a liberal arts field, what is your expected return rate? And yeah, so you're getting these. I just bring up this point though, going back to the main point of don't listen to what the fuck they're telling you to do. They told you to do this, don't do it. Trust me, don't fucking do it. I made the mistakes myself doing that shit. Trust me, you always know what's right for you. You don't need somebody else to sit there and tell you, oh, this is what's right to do. You don't need that. What you really need is to figure out what it is that is right for you and do that full force. Like, there's a saying that I really hate: don't put all your eggs in one basket. Well, if you know that basket is bulletproof, you should put all your eggs in that one basket. And so you need to find what basket is bulletproof for you, right? So that's my point. My point is, like, you have to figure out what's right for you, bruh. And so, like, if what's right for you is investing inside the SPY, and it doesn't matter if you make that 10%, because you know at least you'll make 5%, at least you'll make 6% throughout your entire life, right? 5 to 6%, because bonds are going for like 4.5%. So, you know, that's like the very lowest end that you'll see in your return for your averages for, you know, if you invest in SPY in the Qs. 5 to 6%, you're happy with 5 to 6% compounded for the rest of your life, which is still substantial amounts of money invested, right? Then that's fine. You know, that's what's right for you. If you're willing to take massive risk and you're willing to, you know, risk it on a new concept, a new technology like Bitcoin, if that's what's right for you, then do it. Like, that's the key, like the most important thing. And so I really just say all of this stuff to kind of give you the understanding that you need to be able to figure out what is right for you. Okay? Because this is the truth. This is what's happening. There's nothing that you can say. This is not me. Oh, this is not what's right for me. No, this is what's happening. This is the facts. And so you get to take those facts into your playing field, and you get to make a strategy according to what is being presented to you. So anyways, that's all I really wanted to say. It's nothing really like trading today. I mean, nothing's really happening. It's just they tried to double bottom this and take it back up, and they're still failing. I expect this to probably end up breaking back down one more time to try to break these lows. We do have like a couple more levels over here. We tried here. This is what we did originally. We broke this this here on, this was like right at the end of day, MOC. This was market on close yesterday. We had this massive decline unwinding. We came in beneath that low. So it allowed anybody that sold into market on close, it allowed them to buy at a lower price, and they came back in trying to buy it, and then they sold back into it again because all these sellers, they're trying to get out. People that have been basically buying down here, they're trying to get out just to make sure. And so they're going to take it back down. And there's another couple of levels that we can look for. I mean, I'd say your next level is probably here at 900s even, which is just kind of psychological, but you already broke that technically on this. So yeah, your next level low would be down here at 885, this low. Okay, and so you come down there and maybe they're trying to test for that. Maybe they sweep that low and they take it back up because that's where you had consolidation. So there were bears that were interested in here. Maybe that allows them to cover any shorts that they might have taken. Okay, and then after that, then you're talking about previous all-time highs, which was here, going back. Okay, it's that red line. This was previous all-time high. So that's where you'd be looking after that. And then if we were to keep breaking down from there, which I don't expect will happen, then you're probably looking at this low here, which is August 7th. So that's this high here to hold. So it's just underneath of those all-time highs. Okay, you're looking for that high to hold. So you're basically looking for this breakout to turn into support. So previous resistance turns into support. And if you break down from there, then now you're testing lower values of that, which is probably down to here. Okay, 329. And then after that, you're testing the low from August 1st, which is down here. And that would be over the course of a couple of days. It's not going to happen all in one day. But it's possible that we've hit the top here today. That was it, going up, right? But I don't see it. Like I said, I've already explained. I think that the market wants to continue going up. They're going to do everything they possibly can to trick the consumer into thinking that they should be investing here because the markets are rallying up to new highs, and it's just going to keep going. And so you buy here because in a couple of years it'll be up here. But the truth and reality is that in a couple of years we'll be right here. We're not going anywhere, man. It's going to literally stay in one spot. And if anything, they want you to be buying bonds so that they can pay back and service their debts. That's what's really happening. But there's not much really happening right now in the markets, and it's just going to keep going higher. And so you should be looking at, if you're looking short term, you're like a trader, day trader, weekly trader, intraday, whatever, swing trader, whatever you are. I think personally the best thing that you can do is to be looking for these I think the best possible thing you can do is to be doing swing trades, third expiration of the month. So August has 5 Fridays, so it'd be the 15th, so 2 days from now. You buy calls after the... So usually what happens is you get this rollover effect. And I think that when you roll into the next contracts, that next day is usually red
because it's people repositioning, taking profits, etc. So they're taking profits and getting out, and then that, so like 15th, so the 18th will probably be red, and then the 19th it'll turn back green. And so on the 18th, when it's going down, that's when you buy a bunch of calls for that third Friday expiration of the next month, the 19th. Buy a bunch of calls on whatever company you're bullish on, or maybe you just buy the indice, which would be smarter to do, and you're good. And I think the only reason why you'd be wary of doing that this time is because seasonality-wise, September's one of the worst months. So you don't necessarily want to do it this month, but on the 19th, what I'm explaining again, the 22nd will probably be red, and then the 23rd is when the market probably pivots and starts going back up. And so the 22nd, you should be buying calls while it's getting cheaper and cheaper, and you just keep buying and buying on the way down, and then 23rd, probably pivot and go back up, and then that goes into October, and October is usually a good month for the stocks, except for October has the October surprise, and that surprise can lead the market to be very negative. Like we've had crashes in October, and those crashes skew the data to make it look like October is red, but truly October, November, December are all green months, and so November is very green historically. So if anything, if you're going to continue to go shorts, if you're looking for shorts, this is probably your month to do it, to either put on a bearish put spread, or you could use, if you're thinking that the market's going to go slightly down, or lower, then you could do that. You could take some insurances going into this expiration coming up. So I think that's really what's happening here today, is that people are taking some insurance for the following month because they know that that expiration is coming up here in 2 days. And yeah, that's why we're starting to get a little bit of a sell-off a little bit early. Tomorrow we'll probably continue that same trend. We'll probably get some sorts of relief rally at some point, whether it's today or tomorrow, or after hours today maybe even. And when that happens, they'll probably sell back into it again because they're going to be buying insurances, expecting that September is going to be red. However, there is one bullish case that you could say still, if you want to just go with the normal strategy this month and say go long on these rollovers, is we know that we're going to get a 25 basis point cut. And so that's inflationary, and inflation means that the prices of stocks are going to go up. And so, because their revenue growth is going to go up and it's going to be higher than they're expected, and all these things. So, we could, look at this a million different ways. It's all just depending on what your thesis is. But again, what is right for you, is what's right for you to go short the market, then go short the market, There's ways you can do it and do it smart, but everything should kind of be centered around that third Friday expiration, because that's what's happening. This market is heavily in options, and they're using a lot of 0-day. There's a lot of 0-day expiration volume because of the hedging that has to occur for their monthly expirations. So they're using these monthly expirations on the third Friday expiration, and if the position starts getting, underwater or whatever, they get offsides, then they have to buy the 0 days to basically mitigate that. And so that's what they've been doing. And so it's obviously all in the options market right now, which means everything's highly leveraged. And you got all these factors working basically to kind of prop the market higher and higher and higher. At a certain point, they're going to basically pull the rug out on everybody. Okay, and so that could be this month coming up. So just be wary of that. And that's just about it, guys. I don't really have much more to say, but you should definitely keep all this shit in mind. Understand what's really happening in your economy. Understand how everything works together. All these puzzle pieces, they all have shapes to them, right? Like this puzzle piece has to fit in with this puzzle piece here. And so if you can see what this puzzle piece is, you can then position yourself for the next piece. And so that's really the best
best way to play, the best analogy. Figure out what the market's telling you. Figure out what the data's saying, and then react to it. Don't try to predict what the piece is going to look like. Wait until the piece has been completely formed. Then you know what the next piece is, right? And even then, you're not going to know all the shapes. You're just going to know this divot here, and the rest is going to shape itself out while you have that divot there. And so you position yourself for this divot, and whatever plays out in between, that's what's positioning you for the next divot, right? It's the next piece of the puzzle. So yeah, just keep growing on your information, on your education. I hope this helped.